Yo, what's going on, guys? Bexio, and today we had a brand new video on the stock market. We're seeing some weakness in the market. There's a couple of reasons for that, and a couple of ways that might affect each stocks a little bit different individually, but overall could bring an overall weakness to the market. But before we jump into that, if you are not subscribed, make sure you smash that sub button because we are on the road to 1,000 subscribers. But let's jump right into some of this stuff affecting this market right here, and we can look at the market just like this, just on overarching the S&P 500. You can see kind of stagnant, a little sideways. This is the daily, so this is kind of even going all the way back basically November, which makes a lot of sense when you look towards the wash rule. And this is the wash rule. Talked about it in the video yesterday, kind of talking directly about plug with it, but this is like the overall market going to be going through this for the end of the year. The wash rule is a regulation that prevents a taxpayer from taking a tax deduction from a security sold in a wash sale. So it defines a wash sale as one that occurs when an individual sells or trades a security at a loss, and within 30 days before or after this sale buys a substantially identical stock or security or acquires a contract or option to do so. So what does that mean? Basically, if you buy a stock and it goes down in value and you want to sell it and buy it back, you still like the stock long term, you however you want to think about it, but you could take a loss against it, sell it and buy it back, and then report a loss on your taxes, let you pay less in tax. But if you want to do that, you have to sell it, wait 30 days, and then buy it back. Otherwise, you can't write off those losses on your taxes. So what is 30 days from now? We're looking at about the beginning of next year, which is perfect timing for everyone to buy back into their stocks and go from there. So that wash rule kind of would go with stock. The majority of like the S&P and stuff that obviously isn't in the tech sector is still not doing great. So obviously we know tech and everything brought everything up. When tech exploded, it brought the indices with them, and the other companies in there didn't really affect the index as much as something like an Apple, Microsoft, Google, all of those companies. So that's the wash rule side of it, of those companies dragging the market down because of wash rule stuff and wash sales. But we can also see, so this is the wash rule, if you're taking profits, doesn't apply. So like those companies you're talking about, Apple, Microsoft, Google, Facebook, big tech, all those massive companies that did very well in the past year, people or hedge funds would be selling to take profits, to lock in profits, to show clients they're doing well, they're managing their money good, and they're making them money to justify the fees that they charge their clients. So the wash rule sale doesn't apply to profits or gains of a sale. So this is where different stocks, different companies are going to be affected a little bit differently. So we can see obviously the whole index, this is the S&P 500, kind of trading sideways for the entire month. You look at something like Apple, and it's doing very well. At the beginning of the month, it was around 150. It's 161, so it's still doing good because this selling and wash rule doesn't really apply to Apple because it's at all-time highs. You would have had to buy in September, which still would be very close. You'd have to be selling it right now, which it's up and it's not down, so the wash rule wouldn't apply. More of what we're seeing is profit taking, which you can see like 165 moves down to this 160, and then even went down to 159 today, but bounced back because these hedge funds can lock in profits and then rebuy the stock. No hedge fund or anybody wants to sell Apple and doesn't want to hold it, doesn't think Apple is going to be able to make money anymore. So that's what they're going to do with like companies like Apple. Even companies like Microsoft too is in the same boat because it's at all-time highs. You didn't have this period where it could be lower, where you could wash sale it and then buy it back in the beginning of next year. So it's like the exact same thing as Apple. You see this red candle, probably a bunch of selling, locking in profits, and then continue to do that into today and buying back today. So we're seeing a lot of these moves, but a different one where you could apply the wash rule to would be something like Amazon, where you see how it's super choppy. It's been pretty choppy for a long time, and $3,700. So if you bought in at $3,700, you're down right now. It's under 36, so you're actually down. So you could sell your Amazon to lock in losses if you bought near the last peak, and lock in those losses, wait 30 days, and then buy Amazon back to lock in those losses for tax purposes. We could see that happening with Amazon because of how choppy it is. You just see the difference between this chart where it's super choppy for a long period of time compared to something like Apple, where not very choppy, just kind of continues moving up. Microsoft, even, it's basically a straight line up from anywhere you want to go back to, all the way back to 2020, the COVID drop. So massive straight line up. You're not be able to wash sale Microsoft, but you can lock in profits and then buy back. And that could be what we're seeing in his last couple of days. These last couple of days of, selling and then buying back. So you see downward, up move, down move, probably see it move back up yet again. And we can look at kind of these companies or hedge funds exactly where they're going with these selling by looking at their holdings. If we look at their holdings, we can see like Apple right here. Hedge funds decreased holdings by 4.1 million shares last quarter. So they're selling off Apple shares. Makes sense, obviously, to lock in profits. You look at Google down by 642,000 shares. Microsoft 150,000 shares. Amazon 576,000 shares. So all of these hedge funds are selling off their shares, locking in any profits they had over the year to make sure that they can look at their clients, show them these numbers, and show them we're managing money great. You want to stick with us, and here's our fee that you owe us for making you all this money. So that's why we're going to see kind of choppiness going into the end of the year and a little bit of weakness in the overall market because these big giant tech giants have ran so much. They've made a lot of money for everyone, and now we're seeing them taking profits from them to lock them in for the year. And probably the beginning of next year, we'll see them rally relatively strongly and quickly because everyone will be diving back into big tech because no one's betting against Apple, Google, Amazon, Facebook, all these tech giants. No one's going to bet against them. So they're going to continue buying in and continue to see the growth of these companies. But that's the two reasons that there could be some weakness in the market up till the end of the year. Obviously, wash sales happening with basically anything that's not big tech and recovery plays and things like that didn't really work out. Some people might like them longer term, think they can do good longer term, but they didn't actually do very well for the past few months or the past year. So they're going to lock in losses and then buy them back in the beginning of next year. Nothing crazy going on in the market, pretty normal move. But that's going to do it for this video. As always, don't forget to smash that like button and subscribe. We're on the road to 1,000 subscribers. See you guys in my next video.